Everywhere you look today, prices are rising quickly. Whether you're looking at assets or goods, real estate or stocks, crypto or gold, it looks like everything is a bubble. But if everything is in a bubble, maybe nothing is. Maybe the real problem is in your measuring stick. Maybe the real problem lies with your denominator, your currency, the dollar. The price of gold has recently broken out from a multi-month consolidation pattern and is currently at all-time highs, trading for $3,629 per ounce. Silver as well is hitting prices that it has only seen a few times in history at over $41 per ounce. Bitcoin as well is near its all-time high, trading at $112,000. The S&P 500 is at just under 6,500, and within the last couple of trading days has been playing with all-time highs. The Nasdaq is over 23,000, touching all-time highs as well. The Dow Jones Industrial Average at 45,000. The Russell 2000, which is small caps, is also trading near all-time highs, only being this high a couple of times in the last few years. And the United States Case-Shiller Home Price Index is also at all-time highs. So we have hard assets like gold and silver. We have crypto like Bitcoin. We have the stock market, whether you're looking at high growth tech stocks, mega caps, or small caps, everything touching all-time highs. Even real estate, whether you want to look at the US Case-Shiller Index, or even if you prefer looking simply at the median sale price of houses sold in the United States, which is only down slightly off of its high from 2022. Either way, assets across the board are all at or near all-time highs. But guess what? It's not even just assets. Because if you look at the cost of rent across the United States, also at all-time highs. Or if you look at the cost of ground beef, it is also at all-time highs. Or if you look at the average price of electricity per kilowatt hour in the United States, look at that. It's also at an all-time high. Or if you look at the cost of college tuition, whether you're looking at public or private, in-state, out-of-state, everything is at all-time highs. Or if you look at the cost of health insurance, it is also at all-time highs. Whether you're looking at the cost of rent, the cost of food, the cost of your utilities, the cost of traditional education, or even your healthcare, prices are higher now than they've ever been. So it's not just assets, it is the cost of life in general that is all going up, and nothing has ever been this expensive. Historically, when there is a bubble, it is an outlier. When you looked at the dot-com bubble, and within the course of just a few years, the value of the Nasdaq went from 1,000 all the way up to almost 5,000. You could tell that that was crazy because other assets not exposed to that sector, like if you looked at the Dow Jones Industrial Average, did not have the exact same thing occur. In fact, almost nothing like it occurred. The Dow continued to move basically sideways during that time, while the Nasdaq had its big bubble and then popped. Similarly, when the big crypto bubble happened in 2017, and Bitcoin went from just a couple of thousand all the way up to almost 20,000 within the course of about a year, you were able to tell that it was a bubble because it wasn't happening everywhere. If you compare it to this price of SPY, you can see the overall stock market barely moved relative to what Bitcoin did. The point is, the question that you should always be asking yourself when you are trying to figure out if something is expensive is compared to what? And if Bitcoin and gold and silver and real estate and big stocks and tech stocks and industrial stocks and real estate and rent and beef and coffee, and electricity, and education, and healthcare are all the most expensive they have ever been, then when you say compared to what, you can't compare them to each other because they all look like they're in a bubble. The thing you're comparing them all to there is the dollar. Now you might be thinking, well, if you pull up a chart of the dollar, it really hasn't done much. In fact, it's at the exact same level it was back in 2015. It's had a little bit of volatility, but it's not falling through the floor like you might expect given the price of everything. The reason for this is because, again, you have to ask the question, compared to what? When you look at this chart of the dollar, you are comparing the dollar to other currencies around the world. That's what the DXY is, the dollar index. It's it's a dollar versus a basket of other fiat currencies, which means this chart looks pretty much exactly like what you should expect. Because if every government and central bank around the world is devaluing their own currency at around approximately the same rate, of course, you're not going to have that large of fluctuations in the value of one currency compared to another, which is why the DXY doesn't look anything crazy. Ludwig von Mises was one of the fathers of Austrian economics, and he described something called a crack-up boom. He said, if once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. For under these circumstances, the regular costs incurred by holding cash are increased by the losses caused by the progressive fall in purchasing power. The advantages of holding cash must be paid for by sacrifices which are deemed unreasonably burdensome. This phenomenon was, in the great European inflations of the 20s, called flight into real goods or crack-up boom. In other words, any rational person will choose to get rid of dollars as fast and as soon as possible if they know the purchasing power of those dollars is going to continue declining. People will buy anything and everything they can because at least they're preserving their purchasing power better than if they hold on to those dollars. While we are not experiencing anything closely related to what could be called hyperinflation, this is the phenomenon that we are seeing happen in America today. Those who have the means to do so are buying assets to protect their money. And those who do not have the means to do so are dealing with the consequences of that inflation by buying goods, in other words, the cost of living, at the higher and higher prices. Now, at this point, you may be wondering, is there any way that we can tell that this is actually going on? Maybe there is a bubble happening everywhere. Is there another form of measurement we can use to look at the price of these things to see if they are only expensive in dollars or if they are expensive compared to other things as well? And for this, I would like to show you the price of things priced in gold for a couple of reasons. Number one, when you look back over hundreds or even thousands of years of human history, the purchasing power of 1 ounce of gold stays relatively stable throughout time. Whether you look at the salary of army captains, whether you look at the cost of a haircut, or the price of a custom 3-piece suit, when you price things in gold, it costs the same amount roughly throughout time. In other words, the amount of stuff you can buy with 1 ounce of gold stays about the same, regardless of where you look in history or when you look in history. It is a much more stable measuring stick in order to look at prices. And so when you see something at all-time highs priced in gold, then that is a good indication that it might be expensive. Not a guarantee, but a good indication that it might be. Now, if you take a look at these things priced in Bitcoin, which many people would prefer to do, the only thing you're going to see is that prices are collapsing because the price of Bitcoin has gone up so much, so dramatically over such a short period of time. It is not very useful for looking at a historical measure of prices when you denominate something in Bitcoin. Okay, so right here you are looking at a chart of the S&P 500, except instead of being priced in dollars, it's priced in gold. Now you may be looking at this and thinking, okay, going back to before the year 1900, the value of the S&P 500 compared to the value of gold is elevated, but you're certainly not going to look at this and think, oh my gosh, this isn't a crazy bubble. Obviously, something like the dot-com bubble was absolutely ridiculous. And obviously, something like the early 90s, stocks were extremely cheap, but at a ratio of 1.79, while maybe historically elevated, it is certainly closer to a more normal average ratio. We don't see stocks priced in gold being in a bubble or necessarily cheap. This is a chart of the Nasdaq priced in gold, and while it does not go back as far in history as the S&P 500, we get a similar end of the chart here. This is a chart of the Dow Jones Industrial Average priced in gold, which looks even more fairly valued. Definitely nowhere near bubble territory, arguably not even expensive looking. This is a chart of the Russell 2000 priced in gold. Again, this only goes back to 1987, but this actually might look cheap. You can even look at charts from pricedingold.com to find prices of things like college tuition at Yale priced in gold You can see not only is it nowhere near all-time highs, it's actually a lot closer to all-time lows. They have a chart of electric power in the US, although it does end in 2021. So there's a good chance that electricity prices priced in gold are more expensive now than they were a couple of years ago. But again, not close to all-time highs. You can even look at the price of the median home sale in the US since 1965, priced in both US dollars, which is the green line, or priced in gold, which is the red one. You can see again, not only is this not near all-time highs, it's much closer to an all-time low. Now, earlier I showed you a chart of the dollar versus other currencies, and that did not give you a good indication of what the value of the dollar had done or will do in the future. So the question is, if the US dollar is losing purchasing power versus goods and assets, is there any reliable way to anticipate whether that will continue into the future? One lagging indicator you can look at is the M2 money supply. This is simply a chart put out by the Federal Reserve that shows the total supply of US dollars in the US financial system. Obviously, this chart usually goes up and to the right. After all the money printing that happened in 2020 and 2021, the growth took a brief hiatus, and the money supply actually declined for a short period of time. But it has begun climbing yet again. And if we zoom in on just the last few years, you can see that the money supply is now at a new all-time high, eclipsing the high that it hit in 2022. You can also take a look at this in terms of the growth rate. So this chart compares the money supply right now compared to where it was 1 year previous. You can see that typically the growth rate of the US money supply is between 5 to 10% per year. It peaked in 2021 at 27% year over year growth, and it bottomed in 2023 at a decline of 4.87%. And it bottomed in 2023 with a negative 4.87% growth rate. Now the growth rate of the US money supply is back into its normal range of 5 to 10% and probably headed higher, especially considering that the Federal Reserve is largely expected to begin cutting rates very soon. Given the fact that dollars are loaned into existence, that means lower interest rates are pressure on fueling the growth of the money supply. Lower interest rates are a signal to economic actors to borrow and spend because money is cheap, it's easy, and it's abundant. Which means if you are expecting everything to crash in terms of dollars, you would need a massive departure from what has been taking place with the US money supply for decades. You would need to expect that the US government was suddenly just going to stop borrowing and spending money. You would need to expect that policymakers would be okay with and would allow a deflationary death spiral that would rival or perhaps exceed the Great Depression to just happen again. And while I guess that's technically possible, I don't think that it's anywhere near the most likely outcome, which means I don't think we are in the midst of a bubble getting ready to pop. I think we are just seeing the gradual but consistent decline in purchasing power of the dollar across the board. And if you want to protect yourself from that, you have to be invested in those assets. You have to be diversified across asset classes, not just stocks, not just real estate, not just Bitcoin. If you want help with that, I send out a free newsletter weekly. All you have to do to start seeing me in your inbox every week, click on the link in the description below, sign up. As always, thanks so much for watching. Have a great day.